Should I enter off a fair value gap or an order block? The answer is yes. Well, no. Well, it depends. The first thing you need to understand is that ICT used to solely trade off order blocks, and now we switched to only trading off imbalances or fair value gaps. What did he find out? Why did he end up making the switch? Well, it all starts with a single pattern that is found across all markets and currencies, and in this video, I'm going to reveal what that pattern is and whether you should trade between a fair value gap or an order block. Now, I don't trade the exact same as ICT, but I have my own strategy that I've backtested for years. And while I was learning from him, I took bits and pieces and I turned it into my own. And I found something that was really interesting while I was learning from him. And I found that all markets and all currencies follow one single pattern. Now, what actually is that pattern? Well, it looks something actually like this, okay? And you may be thinking, Jordan, yes, that's a simple trending up pattern. What are you talking about? This looks exactly the same as every single pattern I see. And while that may be true, there's something very important about this that you need to understand if you want to know whether to get in the fair value gap or whether to get in at the order block down here. So I'm going to show you some live examples so you can understand exactly what that is and how this pattern makes sense for your trading. Okay, so to solely dive into get started with the video, the main thing you need to understand is how markets actually move. Okay, you have to understand that banks and institutions control the market. So if we look at a pattern like this, if we have a massive move higher, if I just zoom out here and show you something like this, okay, banks and institutions are always going to be loading in at the very bottom and at the very top of moves. Okay, they're shorting all the way up here, and they're going to be buying all the way down here. Now, it seems pretty obvious, but where this gets really important to understand is that the rest of the move is pretty much manipulation. I can show you a quick example, okay? So the market always takes lower, takes out a bunch of stops down here, institutions load up, and then they drive price higher. Now, when prices moved all the way up here, we see a massive move higher. When we've actually formed a nice consolidation base, that shows us that a lot of retail is actually getting in positions over here, okay? And this is so important to understand because this is where all the manipulation happens, okay? If we know that a bunch of retail are going to be buying in this area, then a lot of institutions and banks are going to manipulate price to chop it around so everybody gets stopped out. I can show you two different examples of the bears and bulls getting stopped out. And then I'm going to tie it back to how this works with fair value gaps and order blocks, okay? All of this dials in, all of this makes a ton of sense. Just stick with me for a second here. Now, when price has made its move all the way up here, you have to understand that it's a bunch of manipulation. So what are they going to do? They're going to drive price higher. They're going to create a fair value gap when that move is higher, okay? And above the fair value gap, after it's made, that's when there's going to be a ton of shakeouts and what I like to call bull traps, okay? There's going to be a bull trap and a bear trap on both sides, all right? So what happens is this is how the market works, okay? We have a nice deep retracement, a nice big retracement where we create a fair value gap. So we'll create a fair value gap somewhere in this area. And then the market will have more manipulation where we'll keep drifting a little bit higher, okay? Trap a bunch of bulls. They're going to drop price down into that fair value gap, trap a bunch of bears, and then move price even higher like so. This is the classic pattern that happens day in and day out, okay? We start with a deep retracement, then we have a small retracement, and we move higher, and the small retracement is actually manipulation, and that's where the fair value gap forms, okay? That's how imbalance is created. It's all the way up here. And the order block is going to be all the way down here, right? So let me give you an example and show you how this works. Price moves up and we form a nice imbalance. We form a nice fair value gap, okay? And as price starts to move higher, we have another bull trap, another spike higher, another bull trap here, another spike higher, another bull trap right here. This is just trapping a bunch of retail bulls who are buying all of these breakouts. What happens is that a lot of bears and bulls, you have people who are shorting in this area, get into this phase where they're just trying to buy breakout, buy when price is all the way high, right, after we've made a massive move higher, and they're just going to expect price to move higher. And in order for that to happen, they need to shake everyone out, and that's when they drive price lower, right at that fair value gap, stop everyone who bought in long here, right, all the retail traders who are getting in long, buying these breakout, they get stopped out down in this area, just like this, okay, and then that's when retail is shorting because they think it's coming back down. It broke below this support, They end up getting short, and then they drive price higher. Now, how does this actually matter when it comes to fair value gaps and order blocks? Well, it's really simple, and it's really a supply and demand concept that I like to call, rally-based rallies and drop-based rallies, okay? Now, every move or fair value gap or every order block looks like something like this, okay? It can either be at the bottom of a move, so we come down, we have a move higher, or it can be in the middle of an uptrend. So we come down, we move higher, we form another one, and we go higher, okay? There can be two different order blocks in this area. So we can have one just like this, and then we can have one just like this, okay? Now, when you see this, you have to understand that this one up here is after the move has been made, okay? So all the institutions, all the banks are buying all the way down here. This is just repricing of the markets when price comes back down to this one. And most of the time, this one will not work, okay? This is where you want to be trading fair value gaps after you've gotten this small pullback. And that's because there's simply not going to be any institutions buying in that area, okay? Because what I like to call is called the 50% rule, okay? Markets are always driven by banks and institutions. And if we take a simple range from, a low to a high, we'll just go from right here, from this low to this high. If I'm a bank or institution and this is the price range we're dealing with, I want to get in below 50%, right? So if I draw my Fibonacci tool from this low to this high, I want to be buying anywhere below this 50% because 50% essentially means fair value. Now, why is this so important? Basically, that tells us that anytime there's a pullback or fair value gap or order block above the 50% retracement, you don't want to be trading order blocks, okay? You do not want to be trading order blocks. You should only be trading order blocks if the price has retraced more than 50% from the low to the high. Now, if a fair value gap forms in this area here, that's when you want to be trading the fair value gaps, okay? When it's higher than that 50% retrace, because you have to understand this is just a repricing of markets, okay? This is not institutional activity buying in this area. They're only going to be buying below that 50%. So let me go ahead and show you a quick example. All right. Now, really quickly, if I zoom out here, I can show you this. So if I zoom in on a smaller time frame, okay, we have a low, we have a high, and we have another low, okay? Now, if I zoom in and go like this, you can see that this low all the way up to this high pulled back 50%. And we came right down into this demand zone or order block or whatever you want to call it, okay? We came right down into this area. Now, after we've already retraced 50%, now what we're going to do is take the retracement from this low all the way to the next high that's formed and see, okay, has price gone back 50% and do we get a fair value gap in that area? And you can see right here that we form a fair value gap in this area. It's a little bit easier to see if I go on like a 3-hour chart, okay? So you want to zoom out a little bit, different time frames, but you can see we have a massive fair value gap in this area. So you may be thinking, should I be buying down here at this order block or buying up here at this fair value gap? And because we already had that retracement of that 50%, right? We already had institutions buying in this area. They already retraced it more than 50%, so they bought back in here. And they drove price higher. This is all just manipulation. Okay, so since the 50% retracement already happened, price can now pull back into this fair value gap, and then we can move higher, right? So you draw your fair value gap, you zoom in on a smaller time frame, you wait for price to come back into that area, come back out, and then you can look to get long and capture this move all the way up like so. Now, all of this is going to tie back into drop-based zones and rally-based zones, okay? So if we have a zone that looks like this, where price comes back down, we have an order block, and then we move up, and then we have a zone that looks like this, where price comes down, we have an order block, we have an order block like this, we come back up, another order block, and then we move higher. You don't want to be trading that mid-order block. You want to be trading order blocks that only form at the very bottom of a move, okay? Not while it's in the rally of a move, okay? So that's really what is the difference between getting in a fair value gap or getting an order block. Because most times this low, this retracement here, has not retraced more than 50% from the previous low, okay? And if that's the case, then this is actually liquidity. So you're going to expect price to come back down below this low, okay? Come into this fair value gap here, and then move higher, okay? Because we already got that retrace down lower. Now, because of that, if you see any type of fair value gap up here, you don't want to be getting in, okay? Because this retrace is lower than 50%. This order block is not going to work. Order blocks that form above 50% will not work most of the time. Will they work occasionally? Yes. But if you want to have the best chance of success, you need to be able to trade these order blocks that are below the 50% level from that retracement, okay? Another prime example would be right here. If I zoom out just like this, you can see price came down. We had a massive move higher. We have this rally-based rally order block right here, okay? And what does price do? Price comes into it, we have a small retrace, and we end up coming back down, okay? Because this wasn't a natural pullback. You know, we came all the way up to this high, pulled back just a tiny bit, and we ended up rallying higher. This was all just manipulation, so this order block wouldn't necessarily work. So what does the price do? Price comes all the way back down below the 50% retracement, level, takes out all this liquidity, and comes right into this demand zone, order block, whatever you want to call it. It's the same thing, okay? So when price comes back into here, that's when you know you want to go ahead and look to get long. So I hope you guys did enjoy this video. If you did, leave a like, subscribe, comment down below other videos I should make. And I'll see you guys in the next one.